In this video, we will show updated versions of charts that all lean bearish for the time being. The charts tend to show a market that is going lower if some type of announcement or intervention does not come out of Europe. The risk of an announcement sparking a reversal attempt is high at the present time. It's Friday morning, roughly 10:20 a.m. on the East Coast, following the jobs report. Today we will be scrolling through several charts, most of which we have shown in the past. We'll be moving fairly rapidly. If you're looking for a little bit more detailed description of the charts, you can find previous videos, and again, most of the charts were shown previously. This is the DAX index weekly chart. This is an end of day chart. On Friday morning, the DAX was trading at 61.01, which means it's violated, at least intraday, this blue line that we noted in the past, which would say the next area of support is about 60.60. Could get a bounce here. If not, there's a lot of white space below. European financials point here. We have violated these recent lows. We're below this pink line. You can see indecision here, and this indecision in this candlestick, here's where price is right here, is most likely related to the thought that some type of intervention is coming, some type of announcement. For now, this is bad news. Typically, you will find policymakers coming out and making statements when you make new lows. They most likely have somebody well-versed in technical analysis telling them we're making new lows here. All things being equal, this is bearish. Another chart we've shown in the past, you can see the EFA foreign stock ETF is still holding above this long-term neckline. If we break it, the target, probabilistic target, would be for about a 27.5% decline. For now, this is support. Similar chart, just looking at different levels of support for the same ETF. As you can see, these support lines for now are holding. Equal weight S&P 500 index. We mentioned markets tend to be healthy above these two blue lines. Bad things tend to happen below them. We are currently below, and where we close, this is a weekly chart here on Friday, may dictate whether we're going to look more like this or this with a bounce next week. Right now, leans bearish. We're also below this 50-week moving average, which currently sits on RSP at 47.44. Last trade was 46.99. We're below it. Both of these lean bearish. 390-day moving average for the S&P 500, support, 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 resistance, potential support. Good things happen when you're above it. Bad things happen when you're below it. We are challenging this line. We've gone below it intraday on Friday. We went as low as 1286. The 390 days at 1287. Currently, as of roughly 10:25 on Friday, we are below this line. Still have a chance to hold above it, but we're pushing the bearish envelope on this chart as well. Shown this in the past. This is 2007 S&P 500 weekly chart. This is a long-term trend line. Resistance, resistance. Blew through this in a bullish manner. We're coming back and we're either testing this here and we're going to bounce, or if we break into this white space, we could fall relatively quickly. Another chart we've shown, we said if we broke cleanly into this area, we may move quickly. We didn't break cleanly into that area, and it appears that we're trying to break below this trend line. We've got support at 1280 and some between 1260 and 1270. This is a daily chart of the S&P 500. Chart that we've shown on short takes our blog in the past. What once was support is now resistance. We came up and bounced exactly where you would expect, here and here. We're now below it. This has been confirmed as resistance now, And if price were to break above that, obviously that would be bullish. We've also got potential resistance in the form of these moving averages. Chart we showed several weeks ago, probably showed it originally when we were up in here. It was one of the reasons why we did some selling weeks ago and lightened up. The target for this head and shoulders with the blue line is 1280. Right now we're at 1287.66, so this is another area where you might look for some bounce, reversal, or policy intervention. This is a monthly chart of the S&P 500. We have not shown this chart before. This rate of change is used in some of our models. That's how we noticed it. This is the rate of change. Typically, when the rate of change goes from below the center line, which is here, and breaks above it, that's a bullish breakout. Here's price. The S&P 500 performed well. Here, you're flirting with breaking the line, but we never broke it. We stayed above this center line, and the bull market continued. In 2007, we broke below the line in a bearish manner, and severe pain followed. Recently, we look a little bit like this. The question is, are we going to move to look more like this? If we do, that increases the odds of bearish outcomes. For now, this is leaning slightly bearish. It's not alarming just yet, but it's in major pay attention mode. I'm not sure we've shown this chart in videos. We've probably shown it on short takes. This is busy. What we're focusing on here is retracement levels. These are Fibonacci retracement levels based on closing prices. So you're looking at the move from this close to this close up here. And typically what the retracement levels tell you is a normal retracement of this move would typically be you retrace to 61.8%, 50%, or 38.2%. And these are areas where you would expect potentially for the market to reverse and continue on with this uptrend. It appears as if on Friday we're breaking below the 61.8% retracement level, which is 1296. The next retracement level is roughly at 1260. This is 1259.17. You can also see that we've got a trend line potentially helping out in that 1260 area. The 38.2% retracement of this entire move off the October low is 1221. This is similar to the chart we just looked at. The previous chart used closing prices. This chart uses intraday prices. Potential support at 61.8% retracement on the S&P 500 is 1289. We're below it currently on Friday. If we close above it today, that would be a positive. These retracement levels, 1248 and 1207, would be the next areas that you would look for a Fibonacci bounce if 1289.59 does not hold. Long-term trends. This is the move, the money printing move induced off the March 2009 lows. These are trend lines that we drew weeks ago, if not months ago. We're touching this trend line here. This trend line was important here, here, and here. So it potentially may have some significance here. From a weekly perspective, if this blue trend line gives away, you could easily envision us moving towards this pink trend line, which would be 1200, 1220-ish. This is the Vanguard All World Index, sans the United States. We've shown this in the past. Intraday on Friday, we are breaking or have broken below this upward sloping trend line. All things being equal, this is bearish for global equities. Doesn't look like we'll retake this line by the close today, so this is going to be a bearish break. Moving averages, see them rolling over here. Negative things followed. We talked about these moving averages rolling over weeks ago. They still don't look healthy. 200-day moving average with a negative slope looking like it's trying to roll over. Again, we could see intervention in Europe or from the Fed. If we don't see intervention, we're probably going lower. You have to keep an open mind about what we call press conference risk. They can announce something at any time, and this market is looking for a reason to rally. If they don't announce anything of substance, then we're probably going lower. This is also VEU on a daily chart, trend lines that we drew a long time ago. It appears as if we've broken this downward sloping trend line that acted as resistance here, support here, support here, support here, resistance, resistance, congestion here, resistance here. These are parallel trend lines. It appears as if we're breaking this. If you're looking for positives here, the MACD on a daily chart really doesn't look that weak here, so this is technically what's known as a slant divergence. Price is making a lower low, MACD is not. It's on a daily chart. It's something to be aware of, but it's not particularly bullish, but we should keep an open mind to a potential reversal because of this slant divergence with price. We've shown this in the past. This is the VEU, Vanguard All World again, weekly chart. This is the 22-week moving average. In the past, when this moving average, the blue line, is rolled over, bad things happened. When the 22-week moving average turned up as far as its slope, good things happened. We mentioned a couple weeks ago that it was flat. Now it appears to be rolling over in a bearish manner, similar to what we're seeing here. Somewhere in this range up here, we got a bearish MACD cross, which is black below red. Bad things happened. We've got a clear bearish cross here. Talked about ADX a few weeks ago. The bearish trends are still continuing. This black line tells you that we've got a strengthening trend, and in this case it's a downtrend. And the fact that ADX is moving up from low levels tells you potentially that you've got a downtrend that's in the early stages and has further to go. Nothing particularly bullish on this chart here, maybe with the exception of that this red line has yet to make a higher high, but that's a reach looking for something bullish. May have shown this chart in the past. We used this in one of our models. This is the VIX, or the fear index. When the VIX spikes, it indicates high levels of fear. This is the S&P 500. When you get a spike and fear is high, stocks tend to drop. You get a spike, fear is high, stocks tend to drop. What we're looking at here is these are moving averages, help us with the trend. The trend is down, trend is up, down, up, down. It appears as if these moving averages are trying to look more and more like this area here and this area here. This is PPO, which is a lot like MACD. When the black PPO line crossed the center line here, stocks continued to decline. Again, this is S&P 500 weekly. Here, you get a black PPO center line cross in here, further declines in stocks. We don't have a black PPO cross, but the trend says that if things don't improve or they don't announce something soon in Europe, we're probably going to get one. This looks similar. This looks similar to this and this. However, notice how tightly clustered these moving averages are here and how tightly clustered they are here. We're not quite there yet. If we continue to see these cluster together and move up in a somewhat vertical manner, that's a red flag. Right now, it's a major yellow flag waving it quite rapidly. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.